Welcome to our channel, where history comes alive through the extraordinary stories that shaped our world. I'm your host, and today we're embarking on a remarkable journey that will take you from the smoky confines of a 17th century London coffee house to the gleaming towers of global finance. This is the story of how a simple establishment serving coffee and conversation became the foundation of the modern insurance industry. A tale so unlikely, so filled with innovation and human ambition that it reads more like fiction than fact. We'll meet visionary entrepreneurs who dared to bet against the sea, pioneers who turned uncertainty into opportunity, and discover how a handful of merchants sharing risk over morning coffee created what would become the most powerful insurance empire on Earth. So grab your favorite beverage, settle in, and prepare to witness one of history's most extraordinary transformations. This is the untold story of Lloyd's of London, and it begins, as all great stories do, with a single moment in time when everything was about to change.
The year was 1686. London's docks stretched along the Thames like fingers reaching into a world of endless possibility. The air hung thick with salt spray and the acrid smoke of coal fires, while the rhythmic creaking of ship masts created a symphony that never ceased. In this bustling maritime heart of England, where fortunes were made and lost with each tide, a man named Edward Lloyd was about to change the course of global finance forever. He had no grand ambitions that morning as he swept the floors of his modest coffee shop on Tower Street. He simply wanted to serve good coffee to the merchants, sailors, and ship captains who stumbled through his doors, their boots still wet with Thames water. But fate, it seems, had other plans for Edward Lloyd's humble establishment. Picture, if you will, the London of the late 17th century. The Great Fire of 1666 was still a living memory, its scars visible in the hastily rebuilt structures that line the narrow streets. England was stretching its arms across the oceans, claiming territories and establishing trade routes that would make the British Empire the envy of the world. Ships arrived daily from the Caribbean, loaded with sugar and rum, from India bearing spices that could make a man wealthy overnight, and from the Americas carrying tobacco that had become more valuable than gold. Yet for every ship that returned safely to port, another vanished into the hungry depths of the Atlantic. The merchants who gathered in London's coffee houses carried these fears in their hearts like stones. They would pace the floors, clutching letters from distant agents, praying that their investments would return safely home. In those days, there were no gleaming office buildings reaching toward the sky, no boardrooms with polished mahogany tables. Business was conducted in coffee houses, where the rich aroma of roasted beans mingled with tobacco smoke and heated conversation. Edward Lloyd understood this world intimately. Day after day, he watched the merchants enter his shop, their faces etched with worry lines that spoke of sleepless nights spent wondering if their ships would ever return. He listened to their conversations, absorbed their concerns, and slowly began to realize that what these men needed most was not just good coffee, but reliable information. So Lloyd began collecting news. He stationed himself near the docks at dawn, speaking with every ship captain who dropped anchor. He cultivated relationships with customs officials and harbor masters, gathering intelligence about which vessels had been spotted off the coast of Spain, which had weathered storms in the Bay of Biscay, and which had simply disappeared without a trace. Soon, Lloyd's coffee house transformed into something unprecedented. Maps covered every available wall space, marked with pins indicating the last known positions of ships scattered across the world's oceans. Tables were cluttered with letters, shipping manifests, and hastily scribbled notes about wind patterns and weather conditions. But perhaps Lloyd's most brilliant innovation was his newsletter, which he called Lloyd's List. Every morning, customers would gather around as Lloyd read aloud the latest shipping news, his voice cutting through the din of conversation. The merchant vessel Bristol Rose, he might announce, has been sighted off Cape Finisterre, 3 days behind schedule due to contrary winds. As months passed into years, something remarkable began to happen in Lloyd's coffee house. The conversations grew more serious, more focused. These weren't just merchants sharing gossip over morning coffee anymore. They were businessmen wrestling with a fundamental problem that had plagued commerce since the first ship set sail: how to protect themselves against catastrophic loss. Imagine for a moment The terror that gripped a merchant's heart as he watched his ship disappear over the horizon. Everything he owned might be aboard that vessel. His entire fortune balanced precariously on wooden planks and canvas sails. One storm, one encounter with pirates, one navigational error, and he could lose everything. It was in Lloyd's coffee house that a solution began to emerge, born from desperation and nurtured by necessity. A wealthy merchant might approach a table where several prosperous gentlemen were enjoying their morning coffee, and with his hat literally in his hands, make a proposal. "Gentlemen," he might say, his voice tight with anxiety, "I have a ship preparing to sail for the Indies, carrying goods worth 10,000 pounds. I cannot bear this risk alone." These agreements were formalized in the most elegant way imaginable. A document called a slip would be prepared, detailing the ship, its cargo, its destination, and the specific risks being covered. Then each man willing to share in the risk would literally write his name underneath the description, along with the percentage of loss he was willing to bear. They became known as underwriters because they wrote their names under the risk. Picture the scene as these slips were passed from hand to hand around Lloyd's coffee house. The scratch of quills on parchment, the careful consideration of each word, the weight of responsibility settling on shoulders as men committed their fortunes to ventures they might never see with their own eyes. The beauty of this system was its distribution of risk. No single man had to bear the crushing weight of potential disaster alone. If a ship carrying 10,000 pounds worth of cargo was lost, and the risk had been spread among 20 underwriters, each man would lose only a small portion of his wealth rather than facing complete ruin. It was, in essence, the democratization of risk, allowing merchants to pursue ambitious ventures they could never have attempted alone. Word of this innovative system spread through London's business community like fire through dry timber. Soon, Lloyd's coffee house was packed from morning until night, with ship owners seeking coverage, wealthy gentlemen looking for investment opportunities, and brokers who specialized in connecting the two parties. The tables where underwriters conducted their business became known as boxes, while the main room where deals were struck was simply called the room. Edward Lloyd himself watched this transformation with what must have been amazement, tinged with pride. His simple desire to serve good coffee and share reliable news had evolved into something far grander, a marketplace where the financial risks of global commerce were bought and sold like any other commodity. When Lloyd died in 1713, his name had already become synonymous with marine insurance, though the institution that bore his name was just beginning to realize its potential. As the 18th century unfolded, Britain's maritime empire expanded at an unprecedented pace. Ships flew the Union Jack in every corner of the world, from the icy waters of Hudson Bay to the spice-rich ports of the East Indies. Each voyage represented both opportunity and peril, and Lloyd's coffee house evolved to meet the growing demand for marine insurance. The process became more sophisticated over time. Professional brokers emerged, men who understood both the intricacies of maritime commerce and the psychology of risk assessment. These brokers would prepare detailed slips describing not just the basic facts of a voyage, but also subtle factors that might influence its success or failure. The underwriters, too, became more professional in their approach. They developed an intuitive understanding of risk that bordered on the supernatural. An experienced underwriter could glance at a slip and immediately sense whether a voyage felt lucky or doomed. They learned to read between the lines of brokers' presentations, detecting the subtle hesitations that might indicate hidden problems. But it wasn't just individual intuition that made the system work. Information was the lifeblood of Lloyd's, and the quality of that information determined whether fortunes were made or lost. Lloyd's List had grown from Edward Lloyd's simple newsletter into an essential publication that was eagerly awaited throughout the maritime world. By the early 1800s, Lloyd's had evolved far beyond its humble origins. What had once been a simple coffee house had become the unofficial center of marine insurance not just in London, but in the entire world. One contemporary observer captured its significance perfectly, writing that, "Not a breeze can blow in any latitude, not a storm can burst, not a fog can rise in any part of the world without recording its history here." Yet despite its growing influence, Lloyd's remained stubbornly informal. There were no official rules governing how business was conducted, no elected leadership, no systematic oversight of the underwriters who bore such enormous responsibility. Business was done on handshakes, verbal agreements, and the unshakable belief that a gentleman's word was his bond. That test came on a seemingly ordinary Wednesday morning in 1838. The Royal Exchange, where Lloyd's had relocated after outgrowing the original coffee house, was bustling with its usual activity. Underwriters were examining slips, brokers were presenting risks, and the steady hum of commerce filled the air. Then, without warning, flames erupted in one section of the building. Fire in 19th century London was every building owner's nightmare. The closely packed structures, the abundance of wood and paper, the primitive firefighting equipment, all conspired to turn small blazes into devastating conflagrations. The fire that engulfed the Royal Exchange that day consumed not just the building itself, but decades of Lloyd's carefully accumulated records. In the aftermath of the fire, as Lloyd's members surveyed the charred ruins of their business, a sobering realization dawned. Their entire operation had been built on relationships, traditions, and informal agreements that existed nowhere but in the memories of the men who practiced them. There were no backup systems, no central authority to maintain continuity, no legal framework to protect either the underwriters or the merchants who depended on them. The response to this crisis revealed the character that had made Lloyd's great in the first place. Rather than scatter to pursue individual opportunities, the underwriters, brokers, and merchants who comprised the Lloyd's community chose to rebuild together. They formed the Society of Lloyd's, giving their marketplace its first formal organizational structure. This transformation from coffeehouse to institution was formalized in 1871 when the British Parliament passed the Lloyd's Act. For the first time in its history, Lloyd's possessed legal authority to make its own rules and represent its members in official matters. The coffeehouse had become a corporation, but more than that, it had become a symbol of British commercial might and financial integrity. That integrity would be tested just 35 years later, in one of the most dramatic episodes in Lloyd's long history. On the morning of April 18, 1906, the city of San Francisco was awakening to what seemed like another ordinary day. The Golden Gate was shrouded in its usual fog, cable cars were beginning their daily climbs up the city's steep hills, and in the financial district, early risers were already at their desks, preparing for the business day ahead. Then, at exactly 5:12 a.m., the earth moved. The San Francisco earthquake of 1906 was unlike anything the modern world had ever experienced. For nearly a minute, the ground bucked and heaved with such violence that witnesses later described feeling as though the earth itself was coming apart. Buildings that had stood for decades collapsed in seconds. Streets cracked open like broken eggshells. What followed was 3 days of hell. Fires broke out across the city, fed by broken gas lines and fanned by strong winds. With the water system destroyed, firefighters could only watch helplessly as the flames consumed block after block of the city they had sworn to protect. Residents fled their homes, carrying whatever possessions they could manage, joining streams of refugees that flowed toward the waterfront and the city's parks. By the time the fires finally burned themselves out, more than 80% of San Francisco had been reduced to smoldering ruins. The city that had been the jewel of the American West, the gateway to the Pacific, the symbol of American ambition and prosperity, lay in ashes. The human cost was staggering. Thousands of families had lost everything they owned. In the immediate aftermath of the disaster, as survivors wandered through the rubble searching for any remnant of their former lives, a familiar pattern began to emerge. Insurance companies started looking for ways to avoid paying claims. Some argued that their policies covered earthquakes but not fire, or fire but not earthquakes. But in London, at Lloyd's, one man made a decision that would echo through history. Cuthbert Heath was one of the most respected underwriters in the Lloyd's market, known for his integrity as much as his business acumen. When news of the San Francisco disaster reached London, Heath could have followed the lead of other insurers. Instead, Heath sent a cable to his agents in San Francisco that contained just 9 words: "Pay all of our policyholders in full." irrespective of the terms of their policies. Consider the magnitude of that decision. Heath was not just risking his own fortune, but the fortunes of every underwriter who had backed his syndicate. He was choosing to honor what he believed was the spirit of his commitments, rather than hiding behind their technical language. In an industry where profit margins often determine the difference between success and bankruptcy, Heath was betting everything on something far more valuable than money. He was betting on trust. The impact of Heath's decision rippled across the American insurance market like waves from a stone dropped in still water. While other companies fought claims in court, Lloyd's representatives walked through the ruins of San Francisco with checkbooks in hand, making immediate payments to anyone who could prove they had been insured by Lloyd's. One particularly poignant account tells of a Lloyd's representative encountering a businessman whose office building had been completely destroyed. The man had lost everything: his business records, his inventory, even his family photographs that he had kept in his office safe. As they stood together in the rubble, the Lloyd's agent asked to see the man's insurance policy. With tears in his eyes, the businessman explained that the policy had been in his office safe, and like everything else, it had been destroyed in the fire. Without hesitation, the Lloyd's agent wrote him a check for the full amount of his coverage. "Lloyd's word is good enough," the agent said simply. News of such incidents spread throughout the American business community with remarkable speed. In a disaster where trust had become more precious than gold, Lloyd's had demonstrated that its commitments were absolutely reliable. Just 6 years later, that reputation would be tested again in circumstances that seemed almost designed to probe the limits of Lloyd's commitment to its word. On the night of April 14, 1912, the RMS Titanic was steaming through the North Atlantic on her maiden voyage. She was not just a ship, but a symbol of human achievement, the largest and most luxurious vessel ever built, a floating palace that represented the pinnacle of early 20th century engineering and craftsmanship. At Lloyd's, the Titanic represented something equally impressive from a financial perspective. The ship had been insured for £1 million, a staggering sum that represented nearly 20% of the entire Lloyd's market's capacity at the time. In an era when most marine risks were measured in thousands rather than millions, the Titanic policy was unprecedented in its scope and significance. Then, at 11:40 p.m. ship's time, lookout Frederick Fleet spotted something dead ahead that made his blood run cold. "Iceberg, right ahead!" he shouted into the ship's telephone, his voice carrying an urgency that cut through the calm of the North Atlantic night. What followed unfolded with the inexorable logic of a Greek tragedy. As news of the disaster reached London, Lloyd's faced its greatest test since San Francisco. The loss was catastrophic not just in human terms, but in financial ones as well. The £1 million claim represented an enormous hit to the market's resources, enough to bankrupt smaller syndicates and seriously damage even the most established underwriters. Once again, Lloyd's response was swift and unequivocal. Within days of receiving confirmation of the ship's loss, Lloyd's had processed the claim and authorized payment in full. There were no delays, no investigations into whether the ship's owners had somehow contributed to the disaster, no attempts to find technical reasons to reduce the payout. Lloyd's had insured the Titanic. The Titanic had been lost, and Lloyd's would honor its commitment completely. During the 1920s and 1930s, Lloyd's began expanding beyond its traditional focus on marine insurance. Aviation insurance became increasingly important as commercial flight developed from a daredevil's pursuit into a legitimate form of transportation. Fire insurance, burglary coverage, and policies protecting fine art and jewelry all became part of Lloyd's portfolio. At the heart of Lloyd's expansion were the names, wealthy individuals who provided the capital that backed the market's operations. These were typically affluent members of British society, aristocrats and successful businessmen who saw Lloyd's as both a profitable investment and a mark of social distinction. Many names never set foot inside the Lloyd's building. They simply provided capital and trusted the professional underwriters to manage it wisely. But there was a crucial detail that many names either didn't understand or didn't fully appreciate. Their liability was unlimited. Unlike shareholders in a typical corporation who could lose only their investment, names were personally responsible for all losses incurred by their syndicates. If a syndicate suffered catastrophic losses, names could find their personal assets, their homes, their businesses, their family inheritances, all at risk. The first serious warning signs appeared in the mid-1970s, with the scandal surrounding the SAS syndicate. This non-marine syndicate had entered into a series of insurance arrangements through a Florida-based agency called Denhar Underwriters, which claimed to specialize in property insurance for urban areas. The policies seemed routine enough, coverage for apartment buildings and commercial properties in New York City, primarily in the South Bronx. Investigators later discovered that Denhar Underwriters was connected to organized crime figures who were systematically buying rundown properties, insuring them for inflated values, and then arranging for them to be destroyed in carefully orchestrated arson attacks. The insurance payouts were divided among the conspirators, while Lloyd's syndicates were left holding massive losses. These losses coincided with a period when Lloyd's was attracting participants more interested in tax advantages than in understanding insurance risks. In the 1970s, Britain's tax rates on earned income were punishingly high, while capital gains were taxed more favorably. Lloyd's income was classified as earned income even for passive names, creating an incentive for some syndicates to deliberately generate small underwriting losses that could be offset by larger investment gains. Perhaps most troubling of all was the development of something called the LMX spiral. LMX stood for London Market Excess of Loss, and it represented a particularly dangerous form of reinsurance, where Lloyd's syndicates were effectively insuring each other in an ever-widening circle of interdependence. The true danger of this system became apparent in 1988, when the Piper Alpha oil platform exploded in the North Sea. The platform, operated by Occidental Petroleum, was one of the largest oil production facilities in the world. On the night of July 6th, a series of gas leaks led to explosions that destroyed the platform and killed 167 workers in one of the worst industrial disasters in British history. The disaster exposed the fundamental flaw in the LMX system. Instead of distributing risk, it had concentrated it. Instead of making the market more stable, it had made every participant vulnerable to losses from anywhere in the system. Lloyd's had created a financial weapon of mass destruction, and Piper Alpha had detonated it. More disasters followed in quick succession. In 1989, the Exxon Valdez oil tanker ran aground in Alaska's Prince William Sound, spilling 11 million gallons of crude oil and creating environmental damage that would take decades to repair. Then came Hurricane Hugo in 1989, followed by Hurricane Andrew in 1992. These storms caused unprecedented damage across the Caribbean and southeastern United States, generating insurance claims that dwarfed anything the industry had previously experienced. But the worst was yet to come. In the early 1990s, Lloyd's began receiving claims related to asbestos, pollution, and health hazards, collectively known as APH claims. These claims arose from policies that had been written decades earlier, primarily in the United States, covering various industrial activities that had exposed workers and communities to toxic substances. What made the APH claims particularly devastating for Lloyd's was the way the market's accounting system worked. Many of these policies had been written years or even decades earlier, but the claims were only now being filed. Under Lloyd's 3-year accounting system, old liabilities were routinely transferred to current syndicate members, even if those members had played no role in writing the original policies. The human cost of these revelations was devastating. Over 30,000 names were caught in the crisis, many of them individuals who had viewed their Lloyd's participation as a conservative investment that would provide steady returns for their retirement. Instead, they found themselves facing financial ruin. Families lost their homes, their businesses, their life savings. The stress of the situation led to numerous suicides, as names who had expected to live comfortably found themselves facing bankruptcy and disgrace. By the mid-1990s, Lloyd's faced an existential crisis. The institution was hemorrhaging money, losing members, and fighting legal battles on multiple fronts. Its survival required nothing less than complete reconstruction, and that reconstruction would prove to be one of the most dramatic corporate transformations in modern business history. The solution, when it came, was called Reconstruction and Renewal, and it represented a complete repudiation of the system that had made Lloyd's famous. The most fundamental change was the abandonment of unlimited liability for individual names. For the first time in its history, Lloyd's began welcoming corporate members, companies, and institutions that would provide capital, but with strictly limited exposure to losses. In 1986, even as the financial crisis was deepening, Lloyd's had moved into its new headquarters on Lime Street, a striking glass and steel building designed by Richard Rogers. The building's dramatic architecture, with its external elevators and inside-out design, seemed to symbolize Lloyd's attempt to reinvent itself for the modern world. Today, Lloyd's has emerged from its crisis as a very different institution than the one that had dominated marine insurance for 2 centuries. It is no longer a collection of wealthy individuals gambling their personal fortunes on shipping risks. Instead, it has become a sophisticated global marketplace where 78 syndicates, backed by over 50 managing agents and billions in corporate capital, provide insurance for risks ranging from the mundane to the bizarre. The modern Lloyd's insures satellites circling the Earth, deep-sea oil platforms, professional athletes' bodies, and even policies covering alien abduction. The principle remains the same as it was in Edward Lloyd's coffee house. If something has value, someone at Lloyd's is probably willing to insure it. Yet questions remain about whether the modern Lloyd's, for all its financial strength and regulatory compliance, retains the innovative spirit that made the original institution so remarkable. The story of Lloyd's is ultimately the story of how human ingenuity can create solutions to seemingly impossible problems. From a simple coffee house where merchants shared their fears about ships that might never return home, Lloyd's evolved into a marketplace where any risk, no matter how complex or unusual, can find someone willing to bear it for the right price. Thank you for watching this remarkable journey through insurance history. If you enjoyed learning about Lloyd's transformation from coffee house to global institution, please like this video and subscribe for more fascinating stories from the world of finance and commerce.